Good morning, everybody, and welcome to the Nedgroup Investments Insights at 10. Thank you all for joining us here today. And today we are talking about passive. We have Jannie Leach, Head of Core, who's joining us. And you'll be covering two things today. Firstly, the Core Bond Fund, a fund that has we've seen more interest and requests. So we'll be covering that for a while. And after that, we'll have our report back for the quarter on the entire core range. There will also be time for questions. If you look at the bottom left of your screen, there is a box which you can click on and you can send questions, and hopefully we will be able to answer them today. So with that, I'm going to hand over to Jannie.
Thanks, Shaun. Good morning, everybody. So like Shaun said, if we go to the overview page, I'm just going to do a short update on the core business and the team. And then I'll look at the core bond fund, and then finally give an update on the multi-asset core range. So we go to slide number 3, so just the growth. So the core business has grown quite rapidly over the last few years. This year we're sitting at just over 33 billion as at the end of Tuesday. A lot of that is because the markets, of course, have corrected quite dramatically during March. But the business is now in its 11th year of existence. The funds have built up solid track records. We have the largest passive or rules-based fund in the country. Our core diversified fund is sitting at just under 14 billion at the moment. And then, our funds are available on most of the list platforms, umbrellas, and are used by DFMs, asset consultants, and I think probably close to 2,000 financial advisors countrywide. If you look at the breakdown just of assets, our core bond fund, the one I'll talk to just now, is sitting at about 1.8 billion. Our multi-asset assets are sitting at about 23 billion, and then our global assets are sitting at about 8.8 billion. In terms of the team update, so in the past it just used to be myself and one analyst. As our business have grown and our responsibilities, the team has also grown. So we were recently joined by Tracy Jensen. She was ex-10X. She was responsible for designing the 10X equivalent of our core range, and so she's got a lot of experience in these kind of solutions. She's also the person behind our new Living Annuity Plus structure that we'll be talking about in the next few months. And then Leonard has joined us recently, straight out of university, and so getting him up to speed in terms of the fund range. The question we get quite often is what really differentiates Nedgroup Investments' core range. There's quite a few different solutions and balance funds available in the market. The thing I think that which differentiates us from our peers is that a lot of the funds started out as partnerships with fund managers, financial advisors, etc. So the way that we focus on these strategies is so that they fit within a financial planning environment. And for us, a really important component is investor behavior. And so in the design of the solutions, we try to build in elements where an advisor would not have to go and explain relative performance risk to the clients. And so a lot of those factors are built into the way it's implemented, the way it's rebalanced, etc. And then, with passive or with quant type strategies, usually it's very smart mathematical people that come up with it, and quite often there's a lot of emphasis on the theory, but not necessarily on the actual practical implementation of that theory. And we've always taken a very practical approach to these kind of strategies. It's important for us to get the big picture right and make sure that you can actually deliver on that solution. So now if I move on to the core bond fund on slide number 6. So the first question I think I'm going to look at is sort of like, why consider a bond fund? In the past, I think the vast majority of investors have made use of your multi-asset income kind of funds, where an asset manager would decide on whether to take more duration, whether to use other sources of yield, etc. Traditionally, bonds funds had mainly been used by multi-managers as a building block within a portfolio for diversification relative to equity. On rare occasions, it's been used as a standalone fund for yield or income. And I think the thing that sort of like has prompted a lot of advisors and consultants and clients who start looking at bond funds at this point in time is the attractive yields that they're currently offering. So partly because of the Moody's downgrading, what's been happening in SA over the past few years in terms of the poor economic conditions, sort of all led to our bond yields increasing. I mean, and it's gotten to the point now where on a typical bond fund, you're getting over 10% yields, which is quite an attractive rate if you think of it from a long-term perspective. I mean, it's nearly inflation plus 6. And then, of course, these kind of funds typically distribute their income on a quarterly basis. So if somebody wants to use it in a living annuity structure, they could use those quarterly steady income to cover cost. And like I said, I mean, at inflation plus 6, it's quite a good long-term yield. Now, importantly, one needs to remember that bond funds are not as low risk as money market funds. They typically experience a lot of capital volatility, but of course the income remains constant. So that's quite important. So if you're only withdrawing the income, then you can endure the capital volatility, but of course you require a longer term time horizon. Now, coming to the core bond fund on slide number 8. So just like we sort of went about in deciding the multi-asset range, when we had to decide on how to structure the core bond fund, we went and we had a look at the bond peer industry. And I mean, we specifically looked at the bond peers who only manage vanilla bonds. So we exclude multi-managers, inflation-linked bond managers, and other tracker funds. And the thing we found was that the dispersion in returns between bond funds is extremely small. So, I mean, if you look at the table on the right-hand side of the presentation, you can see that if I've taken the last 7 years' returns and annualized them, you can see the difference between the best performing bond fund, the worst performing bond fund, and the average. And then if you actually go and have a look at the second best performing bond fund, delivered about 5.8%. And so if you actually take the extreme ones out, you'll find that the vast majority of bonds were actually within a dispersion of plus or minus 0.6% from the average, which is a very narrow range if you compare that to your equity funds, where that dispersion is over 3% per annum in that space. Which means that if you can broadly keep the same duration as the peers, but you charge lower fees, you're going to have a strategic advantage. In other words, you should be able to end up in the top quartile over time. And that's basically the investment thesis behind the fund, is that we're trying to match the duration of the peers, and then we charge lower fees. And then by making sure that we implement efficiently, we save additional costs, and through that in time, the fund should be should deliver very competitive returns versus other bond funds. The funds also achieve scale. So I mean, of course, the bigger you are, the easier it is to manage this. And currently, the fund's sitting at just over 1.8 billion. If we go to the team that manages the core bond fund on slide number 9, so this is exactly the same team that's also responsible for the multi-asset funds. So it is Charles Alderman. So Charles has been involved with the core fund since the inception. And then Liesl Lowe and Keo that assist him on the investment management side. Liesl has taken over a lot of the implementation on the multi-asset funds, and so she's become increasingly more involved in those solutions. Charles does a lot of investment management in bond funds, so he does liability-driven investing models for institutional funds. So he's got extensive experience in the bond space. So just at a high level, I've sort of like covered that the main thesis behind the investment philosophy of the core bond fund is to stay largely neutral on modified duration. The way that we determine the duration of peers is by doing daily regression on peer returns. So of course, duration is defined as price sensitivity. And so by looking at the daily ups and downs of price returns, we are able to deduce what the durations are on those funds. We do attribution, like in terms of where the vast majority of the bonds in our fund sit versus the government bonds or the all bond index, and at various other market dynamics in terms of trading frequency, issuance in the primary market, etc. Then on the credit side, because the peers hold credit, we need to have a certain allocation to credit, but that all follows the Quantas credit process, which is used in our cash solutions, our core income fund, our money market fund, and in their credit fund. And so that's also implemented in a very sensible way, and it typically at the moment, I think there's about 17 or 18% in credit in the fund. And then the key thing that I think is applicable to all the core solutions is just really being patient and practical about implementation and sort of balancing tracking error versus the cost of trading. And that's especially important in the bond space, where you quite often have to deal with illiquidity in some of the bonds. Slide 11 just shows an example of how we determine the duration. So all these lines on the left-hand side is the daily price movements of the vanilla bond peers. And then through that, we are able to determine whether there is an increase or a decrease in duration. Now, of course, this is not an exact science, but because not all the bond managers increase their duration or decrease their duration at a given time, there's more than enough time to allocate and start moving the duration of the fund. As more and more peers, let's say, start increasing their duration, it'll become more and more obvious. So this is broadly the way that we determine that on a daily basis. Most bond funds, of course, don't trade every single day. And so it's important to monitor it, but it doesn't necessarily imply that we have to do any trades on a daily basis. In terms of implementation, so like I said, this is quite an important element in the implementation of bond funds. So, I mean, a lot of these topics are very technical, but I sort of just covered them at a high level. So the first one is basket trading. So this is just going into the market and just buying a basket of bonds. So a lot of bond tracker funds do it. And the problem with that is that some of the bonds are liquid and you're getting good relative prices, others aren't. And so you can be giving away a lot of yield by just indiscriminately investing in these basket trades. So we prefer to follow the approach of just buying one or two bonds, and of course above the minimums, because as soon as you are in those like odd lot bond trades, then again you're giving yield away. So it's just being like practical around that implementation. The second one we use when we really have to, which is spread trading. So this is just when you don't have liquidity and you have to go to the secondary market. And typically what happens in the secondary market, you'll be given a spread for a specific bond above a reference liquid bond. So for example, the R186 would typically be the liquid bond, and then if you want to purchase the R2048, there will be a defined spread, and so you'll basically then buy the R186 and then sell it in the secondary market to purchase the R2048 at that agreed spread. And then the last one is just knowing how the broker market in the bond market works. So typically we prefer to make use of agency brokers. So I mean, there are two types of brokers in the bond market. It's your principal and agency. So agency typically just act on behalf of clients, whereas principals, which are mostly banks, actually hold their own inventory. And so quite often there is, when you're dealing with the banks, there's an asymmetry of information. The banks know a lot more about what's happening in the market, what's trading, and then of course there is a bit of conflict in terms of them trying to trade their own inventory. And so generally agency brokers are preferred. And then there's daily monitoring on how the bonds perform, the maturity, credit, etc. And so those things are just very carefully monitored. I mean, in our multi-asset funds, where we've done attribution versus typical bond trackers over time, in terms of how we do matching duration as opposed to just buying according to the weights per the all bond index. I mean, we've probably saved about 0.5% per annum by just implementing it more effectively in the bond market to doing it. And so the core bond fund is implemented along the same lines. Slide number 13 just shows the current the holdings. So, I mean, what's clear is that the credit component is quite small in the fund. I mean, the vast majority of the allocation is to SA government bonds. If we look at the right-hand side at the maturity spreads in the fund, is that the vast majority of the bonds are also of your longer duration, and then some of that is balanced out by having small allocations to, for example, our core income fund in the portfolio. Fund's current duration is sitting at about, well, it was 5.82 at the end of March. It's sitting at about 5.62 at a yield of about 10.9% before fees. So it's quite an attractive yield from a long-term perspective. And then the final presentation, to some extent, is just the proof is in the pudding, so to speak, that the core bond fund has actually delivered on the strategy. So if we look at the returns, I mean, over the shorter term, the fund has outperformed this peer median that only consists of vanilla bond managers by about 2.5%. I mean, this is partly due to us getting cash flows, and so having a little bit more cash in the portfolio, and therefore withering the drawdown a little bit more. But I mean, if you look at over the 7-year period, there's a 0.7% difference, of which 0.4% is the fee differential, and then I will say there's probably another 0.2, 0.3% in terms of the implementation in the portfolio. And so it is delivered on the strategy of matching duration, and then keeping the flows lower. And you can see the performance. It's the second best performing fund out of those 13 peers. And then if you look at all the other bonds, the multi-managers, etc., it's the third best performing fund. And so sort of just do a quick recap. So, I mean, I think one of the big advantages of the fund is very competitively priced. It doesn't take any bets in terms of duration versus the peers, and then it's sensibly implemented in a cost-effective way. And like I said before, is that one of the big reasons why a lot of people are asking about bond funds at this time is because of the attractive yields. Now, if we move on to the multi-asset funds, I mean, this is where most of the investors are invested in. If I just do a quick recap on slide number 17, the South African Reg 28 range consists of our core accelerated fund. That is basically a max Reg 28 fund, so it's got a combined equity and property allocation of about 90%. Our flagship fund is our core diversified fund, so it's a traditional balance fund, and that's got about 75% in equity and listed property. And then lastly, our stable fund, which is our core guarded, and that's got about an equity and property allocation of about 42%. Our global fund, our core global, this is just the global equivalent of our core diversified, so it's a typical balance, but only global exposure. That fund is available in a USD dollar-denominated fund and in a rand-denominated feeder fund. All these funds on slide 19 have just got the strategic asset allocation, follow exactly the same implementation philosophy. They invested in the same asset classes. The only difference is the asset allocation. And then, of course, on the global side, the core global fund have only got the global asset classes. The funds have got clear rebalancing rules, so the funds are rebalanced on a quarterly basis. So at the end of March, when we saw the massive pullback, the funds were rebalanced back to these strategic weightings, and so they were able to capture a little bit more of the rebound in April, which can be seen on the next slide, slide 20. This is just looking at how the funds have weathered the storm during March, and then I've also shown the year-to-date returns up until Tuesday that captures the rebound that's happened during April. I mean, over the years, I've had a lot of queries from clients that always say, no, but our passive funds generally do worse in bear markets. And as I've said on a previous call, there are some active managers that do better. I mean, you can see it in the 1-month return. Our balance fund and 2 of the competitor funds have done well. But if you look at the vast majority, you've actually had a very similar outcome. So between, I would say, the vast majority of balanced funds were down by between 11 and 14%. Core Diversified was down by 11.5%. The Core Accelerated, that has significantly more risk assets in it, was down by only 14.5%. So, I mean, and that is just a testament to the level of diversification in the funds, of having not just more asset classes, but having more individual holdings and having those caps in place in the equity and the property space. So we can see, if you look at the year-to-date numbers with the rebound, the diversified fund is currently sitting at down by about 6%, and the accelerated fund by about 10.2%. A lot of the peers are sort of around that. There are the exceptions that have been able to produce better returns, but like I said, the majority of the big brand peers are in line, and in many cases worse off than the funds. And so for us, this is quite a nice, it's nice to finally be able to show to clients that a lot of the research that went into designing the funds have actually been able to assist the funds during a difficult time like this. Slide 21 is basically just the guarded fund, and it's exactly the same story as the guarded fund. Was down by about 7.3% during March. A lot of the peers were down by 8%. There are the two exceptions, our stable fund and another competitor fund. Some funds were even down by 12%. And then year to date, the guarded fund is down by 2.4%. Like I said, it's actually better than most of the other big brand peers. Except our stable and one competitor fund. So, I mean, we're quite happy with how the funds have weathered the storm. And again, because they were designed not to have to explain relative performance, I think it's an easier conversation with clients. I thought it would be good to just do a quick contribution, and I've used the Core Diversified Fund as an example of attributing where the returns came from over the past year. So on slide 22, if you look at the left-hand side, it's just a asset class attribution. So you can see the biggest negative or detractors in the fund from an asset allocation perspective have been equity and property, so down by 23 and 57% respectively, which led to about a -12 and -2.5% drop. The downside protection really came from your bonds, and then on the global side, where the rand depreciation has definitely helped. You can see, and that's basically up by 3.6%. I've looked at the individual contributors and detractors on the right-hand side. You can see the top 5 contributors, of course, is the global funds too, and then some of your defensive shares like Sabanya, Clicks and Anglos, and then of course the detractors is on the property and your banks, and then, as we know, Sasol had quite a bit of a shock at the beginning of the year, making it the biggest detractor, and I think most portfolios. Just a quick contribution on the global fund. This is really where you can see one of the design features in terms of offering downside protection is global fixed income. And it's really, if you look at the contribution to the fund returns, like it's your global fixed income that's provided some downside protection compared to global equity and global property, with it both down by double-digit numbers. So -10% for global equity and -21% for global property. And what our research showed is that global fixed income in rands is usually one of your best forms of downside protection in extreme market events, where both your SA and your global equities typically become highly correlated. And just as a final conclusion, I always like the analogy of unforced errors. I mean, investments for me is a little bit like a tennis game that never ends. You can't really ever win it, but you can lose it. And so if you can avoid the number of unforced errors in the whole investment process, you can end up delivering reasonably consistent returns over time. And so for me, the 5 main factors that we try, or the 5 unforced errors that we try to avoid, is having too little diversified risk. And so having a consistent risk asset or equity and property exposure through a cycle is what drives your long-term growth. The second one is by not taking too much concentrated risk, and that's why what we've done is we've diversified it over, like I said, I think it is just over 3,000 shares in total and almost 8,000 fixed income instruments in the portfolios, and then with caps in place for equity and property. We don't try and do market timing. I think it's very difficult to do that, and it comes at costs. and then we try and keep our transaction costs down, and we really pay a lot of attention to all the cost and taxes that's involved in portfolios. And by, I think, combining those factors into the design of the fund, we've been able to deliver reasonably robust performance that is typically well understood of why the funds behave in certain ways during certain market conditions. And that's it from my side. I think we can open up for questions.
Just a reminder, you can ask questions by pushing in the bottom left of the screen the question tab. Okay, I don't think there are any questions. Jannie, I think you've covered a lot of the detail. I just thought then I would close it out. Just in summary, as Jannie said, we're now in the 11th year of existence in the core business. And one of the funds that we are profiling, I think quite a lot at the moment, is the bond fund. So we have a lot of that information that you can receive from your relationship manager. This call will also be available on our podcast channel for those who want to go and listen to it. So I wish you all a happy long weekend, and again, thank you for calling in. Goodbye.